And we had the best economy we've ever had.
And then one day you have to close it down
in order to defeat this enemy.
When things go wrong, knowledge is power. This is Money Talks.
We're back. You're listening to Money Talks. I'm Troy Harmon here with Bil Lako. We're going to just leave it at $1. I think it helps a lot.
It's not quite $1, but
yeah, almost a $1 bill.
Almost a $1 bill.
There we go.
Yeah, I like that.
And Dr. Gene Henssler, Doc, you out there?
I am.
Bill, you've probably had lots of conversations like this in the past week, but I did have one with a client who was worried. You know, you hear on television, yeah, the market's down, it's going up a little bit, it's probably going to go down again. Should I sell now? And to me, you know, I look at history and think about what I would be doing right now. If you go back to the tech bubble days, we're talking about 2000. March 24th of 2000 was the top of the market prior to the tech bubble bursting.
And if you bought on that day,
exactly,
you took all of your money,
right,
and put it in the market, what was your return? Your
return through today with the down market that we've seen would still be about 4.5% or 121% higher than we were at that point. Now think about what you're dealing with there. 37 times earnings. The price to earnings ratio was 37. Long-term average is about 16.5. Where we are today is about 17.5. So
the bottom line is chances of you have putting all of your money in the market on that day is zero if you've been a client of ours.
That's correct. That's correct. Because
Okay.
you would have you would
have been buying up to that price, and you've been buying down from that price.
Exactly. And when you buy at the high price, you get fewer shares. You buy at the lower price, obviously, you're using a similar amount of money,
so you
get
rate of
more
return?
shares. 4.5%.
Annualized?
Annualized.
Over that period of time?
Over that period of time. Can you find a bond, the safe bet right now, that gives you 4.5%?
No.
Yeah, no. And if you did, you would have to take significant risks. You would have to be buying junk,
right,
which generally tends to operate as the equities market anyway. So reality is you can invest your money in the stock market for long term.
We talked before we got on air about if we would have bought at the peak of the financial crisis.
Yeah, absolutely. So if you would have bought at the peak of the financial crisis, that would have been October 9th of 2007, you would make 6.5%, 6.57% per year for 121.5% return on your investment.
So the bottom line, if you would have bought at the ridiculously high point in the tech bubble and bought at not the ridiculously high, but at the top of the market at the Great Recession.
Correct.
You end up with 6.5%.
That's correct. Yeah, annualized.
So the minute you start dollar cost averaging over this period of time, that rate of return jumps. And we're talking to today, aren't we, Troy? When the market is down, how much?
Yes, 18%, a little over 17%.
Okay, so I mean, this is the argument we've always made. If you got 10 years to put it into the market, dollar cost average in, is that it's pretty much impossible to lose money. There's nothing for sure in life, but we do know that if we put it into the market, we really have to have nerves of steel.
That's true. There's a lot of volatility in equities.
And you can't be buying at the top and putting all your money in one time, and you can't be selling at the top all at one time. It's impossible to do.
Right. Now, Dr. Gene, there's a concept that we've talked about as well, and that's dividends. We love dividend-paying stocks, right? The S&P 500 dividend on the whole index at the first of the year was 1.8%. That's the yield from dividends. Today, it's 2.28%. And that doesn't sound like a lot, but over the periods that I just mentioned, from March 24th of 2000, the price appreciation through today is about 74%. So you're getting about 75%, almost 80% more
Troy,
just from the dividend.
2.2 sounds pretty good to me when 10-year treasuries are yielding 0.7.
True.
and 30-year treasuries that yield 1.3.
Right. And think
and
of
those
this.
are fixed. They're never going to go up. You buy them today and you hold them for 30 years. It's 1.3
annually. Exactly.
You buy a $1,000 worth of common stocks to pay a dividend of 2.2, a bunch of different companies. We know what happens is that the dividend goes up.
And the price generally goes up.
And we don't care if the price goes up.
That's correct. But
because all we have is, rather than staying at 2.2% on our investment, it is going to increase over time.
Exactly. So, the thing that you have to think about is the long-term approach that we take. Just like I said, from March of 2000, about 74% of that 157% rather, is dividends. So you got 74% in price appreciation and another 83% in dividend paying you.
And historically, if you take in the dividends and reinvested it into those dividend-paying stocks, the rate of return just skyrockets.
That's exactly right, and that's what I'm saying here. You got 74% in price appreciation. The concept of averaging over time gives you 157% just by reinvesting your dividend.
It appears to me that what we want to say is now's not the time to sell.
Correct.
Now is probably the time to continue to invest in quality stocks, and for right now, for ones that pay dividends.
Absolutely.